Hi everyone, this is Tim Melvin of the Deep Value Report and the Banking on Profits newsletter, coming to you from down here on what's just been another great day, 85 degrees and sunny here in Central Florida. Always get a kick out of the wildlife. Saw a couple gators earlier today taking a little sun bath up on the front pond. So off to a very good day down here in Florida. Anyway, really kicked into gear by the fact that participated in two bank takeovers this morning. One was Fraternity Bancorp up in Baltimore. It's a little four-branch bank with about $162 million worth of assets. And, I said all along Joe Stillwell was up to something in Baltimore because he suddenly swooped in and he bought a bunch of banks. And now one of his holdings, Hamilton Bancorp, has bought two of the other ones, Fairmont and Fraternity. Now, Fraternity, the deal was done at a very small, not much of a premium. In fact, there's a little bit of a discount to book value when you multiplied everything out. And immediately I started hearing from subscribers and readers and, hey, does this mean, look at this. This is a take under. This is awful. Does this mean that because everybody knows these banks have to sell, that people are going to stop paying up for them and the premiums are going to shrink and the whole opportunity is going to go away? Yeah, no, that's not going to happen. Let's look at what happened with Fraternity specifically, okay? What happened here is real simple. This is a small four-branch, most of the action being done out of the main branch on Washington Boulevard in Baltimore. $162 million of total assets, lots of capital with a 14.32 equity to asset ratio. But here's the problem. Federal Savings and Loan Bank primarily focused on that 1 to 4 family market in what is just, I almost said a bad word there, but a not so nice housing market in the general Baltimore area, particularly inside the confines of the city. And it's also an incredibly competitive lending market with lots of bank and non-bank lenders alike chasing the business. It's made it very difficult for the bank to earn high returns. In fact, they earned not so good returns. The return on assets was just 0.2% this last quarter. And if you annualize the ROE, you came up with a whopping return on equity of just 2%. This bank, there was limited appeal. Most of the branches are inside the Baltimore City marketplace, which is nobody's clamoring to get into Baltimore City, okay? At least not at this point in time. It made sense for one, maybe two other banks. And what happened here is Hamilton bought the first bank that might be interested when they bought Fairmont, and then now they've turned around and they bought Fraternity Bancorp. Now, it was never going to be a bidding war for this thing. Only a few banks were interested, did not need a huge offer. So you were not going to see a super premium for this bank. Now, remember, the average premium is about 135% of tangible book value right now. Now, some are going to be top-performing banks. They're going to get above 135% of book, and lesser-performing banks are going to get less than this. And this was a very poorly performing bank, so they got just an okay offer. Now, don't get me wrong. We made money on this. We made about 25% return in just about a year. I will take that all day, every day, forever and ever. Amen. If all my stocks go up 25% in 1 year, going to be a very rich fella. So it's not an unacceptable outcome. We would have liked to see more. Joe Stillwell is on the board of both the acquirer and the seller, so I imagine that he's content with the price and is not going to push for a higher stock price here. This probably is going to be what we get for the bank. But hey, we made money. Now, on these lesser performing banks, the trick here is you're just going to have to be careful about how much you pay. You're not going to want to pay 91% of book value, which is usually our upper threshold cutoff right now anyway, for a bank that's earning a 2% return on equity on a consistent basis. If you're paying 91% of book, you want to have a really attractive bank with a really attractive network that's going to draw in a buyer, hopefully several buyers, that are willing to have a little bidding war and pay a premium for the shares. Not the case here. We take what we got. It's a very nice profit. I'm happy about it. If you were in it and made 25% and you're not happy, I don't know how to make you happy. So anyway, now let's look at the other bank that got taken over today. This was not in the portfolio because I bought it back in 2013 before, of course, we started the Banking on Profit service. By the time the service came out, the bank had moved up to a price where it wasn't 85% of book or 90% of book where we could buy it on an attractive basis. But Yadkin Bancorp has been a very active acquirer And I'll be really surprised if they do not continue to be an active acquirer, particularly in home markets of North Carolina, where the CEO has said he is actively looking for acquisitions going forward. They bought out Newbridge Bancorp out of Charlotte, North Carolina today. Now, they paid 1.6 times book value. Those of us that bought the stock back in 2013, pretty much we about doubled our money. I'll take that too every day of the week, all year long, every day. Look, the bank it's a great little bank. They're earning an 8% return on equity. You had a 0.9% ROA. They're making money. They're growing their loan book. They're just at the threshold where they have to consider either merging or growing. And the CEOs knew each other. They had a good relationship. They both know that mergers are the path to growth. The banks are an excellent fit as far as branch network and culture. So the deal got done. A very healthy premium was paid. You're going to see a lot more of that type of transaction than you will of the first transaction that we looked at Fraternity, where it's a very low performing bank with a very low premium. So average it all out, it's still going to be 1.35 times book value, as long as we're very careful about the price that we pay for these small banks. We should continue to see premiums. I think they're going to stay around that 1.35 times book value. I don't know that it's going to take a little while, some more economic activity, which frankly I just don't see on the threshold right now, to push that takeover multiple higher. If I'm buying at 85 to 90, I'll take 135 every day of the week, especially since, as Chris Marinak at FIG Partners told us a couple weeks ago, book values right now are growing 6, 7, 8% a year. So the value of it's going up every year. So if the multiple stays the same, we're still going to do very, very well over time, as long as we're very careful about the price we pay. Excuse me a second, I'm using this nicotine gum now to kick the vaping device that I use to kick cigarettes, and this stuff really gives you some serious dry mouth. So anyway, that's the story of what's going on in the banks. The opportunity's not going away. As long as we're really careful about the price we pay, the quality of the bank we buy, and we look for activists and bank stock specialists to be in the stock, I think this is going to go on for a very, very long time. Now, this is one of the longest running consolidation trends in history. It started back in the late 1980s. The removal of some key interstate banking laws had an awful lot to do with this kicking off. But the social, demographic, and economic trends that are in place are going to remain in place for several decades still to come. There's going to be cycles and waves, but there's still going to be plenty of opportunity to make money in the small, regional, and community banks for a long, long period of time. And it's funny, not long ago I was talking to a friend of mine who does a much more macro kind of thing than I do. And he said that in reviewing everything that he'd done over the years, this guy's done pretty well for himself. He said that almost all of his money, with all these fancy schemes and theories and bets and market guesses and all this stuff, most of his money had been made by buying and holding carry trades, participating in long-lasting carry trades. Now, we don't do a lot of that, but I can compare, the consolidated carry trades being the major source of profits for macro guys. I think for a lot of us value guys, consolidation trends are one of the most important sources of profits over the years. You get an industry that's out of favor, costs are too high, it's difficult to make money on a standalone basis, it's too highly regulated, and a certain amount of consolidation is going to start to happen just to keep spreading those costs over a larger asset base. So I'm thinking back over my career, we're seeing it in auto parts suppliers, radio and TV in the 80s and 90s. And my goodness, that was just so much fun because it seemed like there was a deal a day. It was just insane. Utilities, 80s and 90s, and even into the early 2000s, and even currently, we're seeing utilities merge just to gain larger scale in what is very cost and regulatory intensive business. Hospitals continue consolidating. Health insurance companies have been a strong consolidation, especially since Obamacare passed. But that's slowing down. And there's only 18 health insurance plan companies publicly traded in the United States. So I'm not too sure how much more we can cut that down. There may be a couple of small ones that get bought, but they're about done there. And just think about airlines and all the consolidation that's gone on in that industry over the years. Now, in addition to the banking trade, which I do believe to be the longest lasting consolidation trade of my lifetime or pretty much any other investor's lifetime. I see two others out there right now. Keith Bryant Woods has done a lot of work on the fact that the situation in the property and casualty industry is not all that different from the situation in the banking industry. Lots of new regulations coming in, both on the state and the federal level. Very hard for smaller property and casualty companies to compete against the data and technology used by their larger competitors to gain an edge. So at some point at the end of the day, it just makes more sense to sell your company to the guys that have a significant edge over you. There have several reports from Keith Bryant Woods. They're doing a fantastic job of staying on top of that. But we're starting to dig through some of the P&C stocks to see if we can find some great bargains that we want to hold to take advantage of this. Unfortunately, I may be just a tiny bit late to that particular party. Happily, I think I'm a little bit early in the REIT consolidation trade. I wrote on Real Money a few weeks ago that Green Street Advisors, one of the best REIT research firms, has identified the fact that, hey, they really think that there's going to be a lot of merger and acquisition activity in this space simply because most REITs are selling for about 15% less than the actual value of the buildings that they hold. Sam Zell said something similar about this industry about a year ago when he said that, in his opinion, the smaller REITs just could not compete due to lack of equivalent access to the capital markets, we'll call it, scale when it comes to costs with the larger REITs, and then a lot of them are just going to be forced to sell their property portfolio to their larger competitors and exit the business. Now, Mr. Zell probably knows more about real estates and REITs than anybody on the planet, so I kind of tend to take his advice when he's kind enough to offer up advice about real estate investing. We have identified several areas that we think are very attractive targets. We've got them in the portfolio. We're actively looking for some more because we do think there's going to be, not going to last as long as the banks can. There's not as many of them to choose from, but there is going to be some ongoing consolidation activity in the REIT space. But again, primarily the biggest consolidation trade you'll ever see in your lifetime is the banks. Now, the energy stocks are going to eventually see a consolidation trade, but we all know what's going on there. Okay, low oil prices are pressuring the energy companies and the oil service companies. We're going to have a shakeout. As the hedges run off, particularly here in North America, we're going to see who can survive and who cannot survive, and we need that shakeout. Marginal players in exploration and production, drilling, and of course oil services, they need to go ahead, file bankruptcy, get out of the way so we can see exactly what the landscape looks like at this point in time and going forward. And then you're going to start to see an awful lot of merger and consolidation activity as stronger companies buy the weaker companies and get those valuable assets at very attractive prices. We're going to be watching for that to happen. We've got some companies that we think are almost certain to get bought by a larger competitor once the financial excess is wrung out of the industry by sustained low oil prices. We think that will be a quite lengthy consolidation wave. And we're ready for it. We're looking forward to making money in it, but there's not really any triggers to pull at this point in time. We're going to stay with those energy companies that we've identified as safe and cheap that we already have in the portfolio. Not really excited about doing too much additional in the energy space right now. Now, I do have to throw out, before we go away for this, today, a couple book recommendations. I know I've pulled back from doing these, but if you're a baseball aficionado, you have to be a big baseball fan for this. This is not for the casual baseball fan. But Pitch by Pitch by Bob Gibson goes literally but through the thought process and the strategy of every pitch he threw in the opening game of the 1968 World Series, where he set the then record for most strikeouts in a World Series game. Absolutely fascinating read for the strong baseball fan. Pick it up, just came out, pick it up, read it, you're going to love it. Now, for the, excuse me again, folks, for the really twisted and demented folks out there among us, Christopher Moore's new book, Secondhand Souls, is out, and it is as demented and funny as everything else he's ever written. So if you're a fan of Christopher Moore, you should run out and pick that up. If you're not, don't start with this one. Go back and read some of his early works to kind of build up through the current level lunacy and dementia, I guess, that Christopher Moore brings to a book. That for just fun, relaxing reading in the Travis McGee kind of mold. There's the Trailer Trash series by a guy named Ed Robinson. It's just, look, they're just fun, okay? About a boat bum by the name of Mead Breeze and all his adventures rolling around the Florida Keys and the Caribbean. Anyway, just fun reads, nothing serious about those, not too many deep life lessons to be learned. But you'll relax and enjoy yourself, and it's probably better than most of the crap that's on TV tonight. So anyway, speaking of TV, we've got the debates, we've got baseball. Just going to be a great evening around Shea Melvin, so really looking forward to that. My son and one of his friends who's down from Maryland is coming over. We're going to go out to dinner here in a little bit, so we've got to get running. But anyway, the bank consolidation trade is alive and well. Premiums are not going to shrink. They're going to stay at around the same level, maybe work their way higher over time, and there's still just a ton of money left to be made in the community bank stocks. Have a great week, everybody.